This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 234 was recorded on August 27th, 2020. I'm Erik Townsend. This episode is brought to you by TopTradersUnplugged.com, a podcast dedicated to quant and rules-based investing, helping investors overcome behavioral biases, and by FarmTogether.com, bringing farmland, a new trillion-dollar investment opportunity within reach of all accredited investors. Santiago Capital founder Brent Johnson returns as this week's feature interview guest. We'll discuss the U.S. dollar in depth, including why Brent thinks the dollar bears are a little premature in declaring victory. We'll also discuss stocks, gold, and much more. Then be sure to stay tuned for our post-game segment when Patrick has prepared another of his famous chart books. We'll go a little bit deeper on some of the things that are going on in the market and what's driving them.
And I'm Patrick Ceresna. Now, Erik, let's talk about that S&P 500. No sooner did we go past the option expiration that we did get volatility, but it was to the upside, and everything seems to be just running full throttle. What's your take on all of this?
Well, I think it's exactly what I predicted last week, Patrick. Remember what I said is it's perfectly natural to see a pause here as you hit a technical resistance level of the previous all-time high. Some people thought it was going to be a double top. They had to sell it. We had to go through that little bit of uncertainty there. But as soon as we broke out to the upside, we saw a dramatic acceleration of upside momentum. Exactly what I described last week. So the fact that we're up another 100 points almost in a week since we spoke last week doesn't surprise me at all. I think that this clearly proves, to my mind at least, that markets are being driven by central bank stimulus expectations more than underlying economic fundamentals. And quite frankly, that's been the case since 2009. If it hasn't been clear until now, it certainly has to be clear by now. But interestingly, Brent Johnson has a different view, and he's challenging the very commonly held belief that it is central bank money buying bonds that puts the money in the hands of banks that they can go use to bid up the stock market. Brent's got a different view. We'll get to that in the feature interview.
All right, well, let's move on to the U.S. dollar, because more or less the entire month of August was pivoted off the 93 handle, up a little bit, down a little bit. But really, finally, the selling has somewhat subsided, and we're in this sideways trade range. Is this where dollar bottom comes in, or do you think there's more downside?
Well, I'm going to get into a lot of detail with Brent Johnson on this one in the feature interview. But briefly, my take here is, it's very interesting to me that you hear the talking heads on the cable networks and the pundits talking about how horrible it is for the U.S. dollar, how it keeps on selling off. Well, wait a minute. Come on, guys, let's look at the chart. It was almost 2 weeks ago that the market bottomed, at least so far, at just about a perfect 92 handle on the dollar index. Now, that doesn't mean it isn't going lower, but what it's been doing since then for the last couple of weeks is consolidating. People are still talking about it as if it's selling off viciously when that's not really what's happening. It suggests to me that there's plenty of room for an upside reversal, as so many people have become so obsessed with this idea that the dollar is crashing. Dollar has definitely been weaker than I expected it to be, but it's not crashing. That's just not reality. Maybe it's about to crash. I don't know, but it's not crashing yet. In any case, Patrick, let's get Mr. Dollar Milkshake himself, Brent Johnson, to comment on this in detail in today's feature interview.
All right, well, Erik, let's move on to crude oil, because crude oil is just doing a lot more of the same. It tries to break out to the upside and then just doesn't follow through and then just kind of muddles back down towards its trade range. What's next for oil here?
Well, as you say, we've had 2 solid months of sideways consolidation in a very narrow trading range, what traders call a coiled market, probably getting ready to make a big move in one direction or the other. Now, the strength this week kind of makes it look like, okay, it's an upside breakout that's coming. The thing is, you've got to understand, the strength this week has been entirely about the tropical storm activity in the Gulf. It's important for people to understand, though, it's a double-edged sword. It's not as simple as a lot lot of people outside the oil market. They think it's just you get bad weather, hurricanes, makes the price of oil go up. It's not that simple. Bad weather in the Gulf of Mexico, which forces shut-ins of producing rigs, offshore rigs, that are out in the Gulf of Mexico at risk. They have to be shut in because the storm is coming. That takes production offline. That pushes the price higher. But when there's a risk of a storm surge causing flooding, which could cause a lot of serious damage to the refineries on the Gulf Coast, if you have the risk that refineries could be taken offline for, say, 6 months at a time because of a whole bunch of flood damage, that is crippling demand for crude oil because that refinery capacity coming offline means the refineries can't use the crude oil. So that tends to have a downward effect on the price of crude oil and an upward effect on the price of RBOB gasoline futures. That's exactly what we saw through Tuesday. RBOB gasoline through the roof to the upside, taking out all the technical levels, looked like there was just no tomorrow. Well, really, crude oil wasn't reacting nearly as much. Why is that? Because everybody knows gasoline is going to be in demand. You can't get too excited about crude oil prices because you don't know what's going to happen to the refineries. We got to mid-session or so, just about, I think the peak was right around 10 a.m. on Tuesday, and it's been downhill, sharply downhill since then for RBOB gasoline futures, probably because people are interpreting the weather data to say, okay, this is a bad storm, but it's not going to put the refineries out of business for the next year. It's not that bad. And I think that was feared at one point. So that's why gasoline prices have come back down through most of their key moving averages, through the 5, through the 8, sitting on the 13-day moving average as we're speaking. Crude oil, on the other hand, bouncing up and down, kind of following in sympathy with RBOB gasoline, but not nearly as volatile. And again, the reason for this is you've got this two-pronged effect of normally the bad weather causes prices to go up unless it's compromising refining capacity into the future, then it's different. So that's the big picture of what's happening with the fundamentals. As far as inventory is concerned, crude oil drawing down 4.7 million barrels, plus another drawdown of 108 million barrels on the Strategic Petroleum Reserve. That's a 6.5 million barrel net drawdown on crude oil inventories. Now, normally we don't count the SPR because that's government oil. It's not commercial oil, except they started leasing it out to private interests. So I treat that whole 6.5 million barrels, at least in my head, that's the commercial storage drawdown for last week, and it's a doozy. That would normally be a really big upside in prices, and we didn't really see a big upside on oil prices. It's kind of suggesting that this market's not ready to break out to the upside yet. Maybe once the weather event is over, we're headed back down, is probably my gut feeling at this point. Cushing, Oklahoma, drawing down 279,000 barrels. Gasoline drawing down 4.6 million barrels. Great big draw there. Distillates building 1.4 million barrels. U.S. production ticking up just 100,000 barrels, one tick up to 10.8 million barrels. I think the big catalyst for much higher oil prices is when you see U.S. production fall off a cliff, as Art Berman has predicted it would in Q4. It's not Q4 yet. It's not time for that. I think before the end of the year, we may see a dramatic decrease in U.S. production, pushing prices higher. But it's not happening yet. We're going the other direction, at least in a small way, for this week.
All right, well, let's move on to gold because gold actually popped earlier today. It looked like we were going to take a stab back at 2,000, and then it reversed, and we're heading right back to the bottom of that trade range. It doesn't seem like gold is ready to commit yet to the upside. What's your take here on what gold is doing?
Well, I think it's still unclear whether this correction that we're seeing in gold has farther to go to the downside. And as a gold bull, I hope it does. What would help to clean out the system, so to speak, and make for a healthier bull market is to have a more significant downside correction to shake out those weak hands and set the stage for the market to move much higher. So I really hope we get at least down to just over 1,800. I'm going to ask Brent Johnson. Brent for a long time was really sticking to thinking it was going all the way back to maybe 1377 or at least 1400 before this was over. I wonder if Brent still thinks that. We'll ask him in the feature interview.
All right, and finally, let's just touch on the 10-year Treasury yields. We've obviously seen yields rising here in the last little bit. What's your take on all of it?
Patrick, as our regular listeners know, I'm not even paying attention to the short-term moves in the 10-year. The big questions on my mind are we headed toward a return to secular inflation, or is deflation going to continue for a while longer? And are negative interest rates on the U.S. 10-year a possibility? Those are the things I'm thinking about. I'm going to have quite a bit of conversation with Brent Johnson about those. As far as the recent backup in the yield in the last few days, no opinion as far as I'm concerned.
Well, this week's feature interview guest is San Diego Capital founder Brent Johnson. Now, Erik, why did we invite Brent back on the show this week?
Well, Patrick, Brent Johnson and Jeff Snyder have been the two voices that have been most outspoken in explaining why a U.S. dollar squeeze was likely to push the dollar index higher, U.S. dollar appreciating against other currencies. Clearly, that's not what we've seen in the last month. We're seeing the opposite. I really wanted to get Brent back to find out, does that change his fundamental view? At some point, there's got to be a level where you say, okay, this proves that I got the call wrong. Is Brent there yet? Is Brent ready to concede that maybe Luke Gromen is finally being proven right in his outlook on the dollar? Or are we not there yet? Let's find out what Brent has to say in today's feature interview. Listeners, we know many of you agree with us that we're the best financial podcast on the internet because that's what iTunes and Apple Podcasts used to say about us. Unfortunately, we haven't been reminding you to do those ratings and reviews, which keep us in our number one slot, which we really feel like we deserve. And by the way, that's what helps us get the very best feature guests to come on the program. So your ratings and reviews really do help us to get better feature interviews for your future listening pleasure. Writing a 5-star review for MacroVoices is simple. The instructions step-by-step are in your Research Roundup email. This episode was made possible by TopTradersUnplugged.com. In recent weeks, we've been reminded of the fragility of world financial markets and how quickly sentiment can shift from risk on to risk off. Once again, the mantra of buy the dip and the determination of central banks will be put to the test. But as Chris Cole recently told us, the best approach to investing in the long run is very different from what's worked best in recent decades. To help MacroVoices listeners navigate an uncertain future, Niels Kastrup-Larsen, host of the Top Traders Unplugged podcast, has created a guide to the best investment books of all time. You can get a free copy at toptradersunplugged.com/macro guide. And be sure to listen to my full-length interview with Niels Kastrup-Larsen on trend following. The download link is in your Research Roundup email. Check out toptradersunplugged.com today. You'll be glad you did.
Erik's interview with Brent is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Santiago Capital founder Brent Johnson. Brent has prepared an excellent slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads next to Brent's picture. Brent, it's great to have you back, but you know, buddy, we got to start with the U.S. dollar because both you and I had a view that likely the dollar was maybe going to head higher. It hasn't yet. It's going the opposite direction. What's happening?
Well, we've kind of had, there's that famous book, A Tale of Two Cities. We've had a tale of $2 moves so far this year. And yeah, you're right. Things were really moving higher in Q1. We thought it was likely we'd get a little bit of a pullback in Q2. We did not expect it to pull back as far as it has. So I'm happy to address all this. And, I will say, just to make it absolutely clear, because I know there's a number of people who are going to ask, is it over? And I will state my case very clearly. It is not over. There is much time left in this game that we're playing, but happy to walk through some of these slides and tell you why I feel that way.
All right, let's hit it with slide 3. What's going on with the dollar index?
Well, this just basically shows kind of what I just talked about the different moves so far this year. So we started the year around 96.50, something like that. In early March, we had a very quick pull down and an enormous move the other way. And that's one thing I'd like to point out is, On March 9th, the dollar index was around 94. 11 days later, it was 103. So these moves, when they happen, can happen extremely quickly and kind of come out of nowhere. And that's kind of the nature of the design of the monetary system. And we'll get into that a little bit later. But, since then, we've had a huge move the other way. Now, we thought we'd get a pullback, but maybe to the 95, 97, 96, 95 level. We did not expect it to pull back down into the 93, 92 level, which is where we're at now. And so that's about a 10% move that we've had from the into year high, which is a big move. And so I'm not going to sit here and be oblivious to that fact. I don't think it changes the end game, but it has certainly changed the middle of the game. So, I've had a number of people kind of over and over, whether it's emails, Twitter messages, DMs, phone calls, insisting that, the dollar trade is over. The milkshake has melted and spilled and it's gone sour. And, it was the dumbest idea that anybody's ever had, et cetera, et cetera. And, I think what I would say is, the day of the dollar high, I actually sent out a tweet because at that time I was getting all kinds of messages the other way. Oh, I'm on Team Dollar. This thing's going to 120. It can't be stopped. And the point I wanted to make was that, listen, I very much believe that is the case. And I very much believe that we are going to all-time highs in the dollar. But this is not going to happen in a straight line. There are going to be moments of pain along the way. I sent out this tweet that said, if you're new to this, you have to be ready for a pullback. The Fed is going to do something. The monetary authorities are not just going to sit back and let this happen. And when they do, it's going to hurt. And you know what? That's exactly what they've done. They've been more successful at it than I initially thought that they would be. But it is what it is. And so, I am of the belief that if you have a portion of your portfolio that is allocated to speculative capital and some asymmetric type returns, this is a fantastic opportunity to put some of these trades on. And so, one thing on page 6, I wanted to just show some of this, how dramatic this dollar pullback has been. We had the big move up in the first 3 months of the year. The next 2 months or next 3 months kind of started to give that back. But then we had July was one of the worst months in a decade for the dollar. I think the last time it was that it had a month like that was 2010. That was as a result of early QE. It might have been a QE2. I can't remember. But it is what it is. And so the reason that I think that the now is a good opportunity is severalfold. Now, first of all, if we look at page 7, I put a couple different charts using technical analysis. Now, again, I'm not oblivious to what happened. I mean, the dollar just kind of sliced through that short-term support that we saw at around the 95, 96 level on the weekly and the monthly charts. And it's fallen all the way to 10-year support levels on both the weekly and the monthly charts. And we think that is very strong support. Now, if something happens and they push it through that, then we're probably going to the mid 80s. And I can't sit here and say that's impossible. Anything's possible. I would say that everybody, regardless of asset class, needs to be ready for anything. So for me to come in here and say that it can't happen would be wrong. It can certainly happen. I don't think it will, but it can. But if we go to the next...
Hang on 1 second, Brent, before you move on from this slide. You talked about the technical analysis side of it, and I understand that. But I want to touch on the fundamentals here, because if we did see a breakdown below these trend lines that you're seeing... Now, something you and I have discussed in the past is our mutual friend Luke Groman has a view that the U.S. dollar is going to fall out of its preferential status at the center of the global financial system, lose its reserve currency status, and really, really be in big trouble. And you and I have both agreed in the past that Luke will be proven right someday. We just thought he was way early. Why wouldn't you interpret what's happening now, and especially if you broke through the technical levels that you have illustrated on page 7, why wouldn't that be interpreted as the signal that says, okay, the dollar is having its Luke Groman moment. It's the beginning of the end?
Well, I think the answer to that, Erik, would be the reason that it broke through that technical level. Now, if the reason that it breaks through that technical level is because a new Plaza Accord is announced, and they come out and say that we have an agreement among nations that we are going to devalue the dollar over the next 2 to 3 years, then Luke would absolutely be right. If that happened, if it broke through that level, because 4 other countries got together and said, we are no longer going to trade with the United States, and we make up, a big enough percentage of the global economy that it will drive the dollar lower and the U.S. will see its worst days ahead of it, then that may be a reason to do it. If a new global dollar payment system or a new global payment system that is non-dollar is adopted by the rest of the world, and that's why it breaks through that level, then Luke would be right. But if it just breaks through it because the Fed comes out and makes some comment, or because the ECB comes out and bluffs and says that we are in fantastic shape, then I would just say it's been delayed. And that's one thing I was going to address at some point here is, first of all, you can be completely wrong. And it's possible I'm completely wrong. I can't rule that out. The other type of wrong is you can be early wrong. Now, don't get me wrong. In this business, if you are early, you are still wrong. But being early wrong doesn't kill you. And it annoys you. It's frustrating, but it doesn't kill you. But if you're just early wrong and you're eventually right, like many people in the gold world were early wrong for the last several years. Now, they're looking pretty smart today, right? They got the timing wrong, but now they're looking pretty smart. Same thing here. I can be early wrong, but early wrong, if you've sized things correctly, if you have risk management tools, it doesn't kill you. And it still gives you the opportunity to make it back later on. And that's kind of where I think we are right now.
Brent, if I look at the technicals again that you have on page 7, it seems like, okay, the obvious setup is this is a buy. We're hitting that support line. What's the fundamental argument that would take us higher? Why would we expect a bounce from here?
Well, there's a couple other things, Erik. And one thing I would say is the huge sell-off in the dollar has caused the relative strength to just plummet. If you look on slide 8 on the right, that's the relative strength of the dollar. Again, the relative strength on the dollar hasn't been this low in over 20 years. It got down into the mid-teens, which is extremely low for RSI. Now, the other thing to remember is that the dollar index, the DXY, is about 57% euro. So really the DXY is almost a proxy for euro yen versus dollar. I didn't put up the trade weighted dollar and the Asian dollar index. If you look at those, the dollar is actually doing pretty well against most world currencies. It just so happened to be falling against the euro. But as the dollar index sentiment got completely washed out, the euro sentiment, the euro relative strength, again, is at the highest it's been in 20 years since it started trading. So, we've got these extreme moves in relative strength. And then on the next page, this is a service that basically just tracks sentiment. And as of yesterday, the sentiment on the euro was 75 and on the dollar was 19. Now, 10 days ago, or about 2 weeks ago, the euro daily sentiment index was in the high 80s. And the sentiment on the dollar index was 8. Again, anytime you're over 80, 85, or below 15 or 10, again, these are extreme moves in sentiment. So that would be another argument. And then if you go to page 10, this shows since the euro started trading in 1999, the speculative long position on the euro has never been higher. Now, that doesn't necessarily mean that it's going to turn down. I'm just pointing out that the big trade, the consensus trade, is that the euro is going higher and that the dollar is going lower. And then, Zero Hedge put an article out the other day talking about how short dollar is now the world's most consensus trade. And they showed the net speculative position on the dollar to be the biggest dollar short position, just trading position, in like 20 years. And then finally, another way to track sentiment and technicals and kind of a combination of things is DMARC analysis. And, a week ago, there was both a DMARC setup and a DMARC countdown indicators that were both triggered. And, historically, when these have triggered, it's led to a pretty decent bounce in the dollar. Now, Erik, any of these things I've talked about in the last, 3 or 4 slides and in the last few minutes, taken alone doesn't mean a lot. But when I have this many things lining up and I have a fundamental belief that the dollar is going higher long term, it just shows me that in the short term, we're due for a bounce. Now, does it guarantee that we're going to have a bounce? Absolutely not. It does not guarantee anything. I'm just pointing out that we have a very good setup for a bounce in the dollar. What happens after that? I don't know. The funny thing about this business is a lot of people are afraid to say they get it wrong. But think about this. Our job is essentially to predict the future. Now, anybody who thinks that they can predict the future and never get it wrong has to have an ego the size of Mount Everest. That's why I don't mind saying when I get things wrong. I'm going to get a lot of things wrong. I can't predict the future. All I can do is play the probabilities. And right now, I think the probabilities are for a dollar jump.
Okay, but the best of the best who know that they can be wrong also think about what it would take to prove them wrong so they know what to watch out for. What are you looking out for that would tell you, hey, got this bounce thing wrong, it's time to switch positions here, and it really is going lower?
Yeah, so this kind of relates to what we talked about just a few minutes ago. And one of the biggest questions I get all the time, people email me or Twitter DM me and say, what's your stop? Do you have a stop price? And the reality is I don't have a stop price. But I have events that would cause me to stop. And this is kind of what we were talking about earlier. I think if there was a new global payment system that was developed and adopted by the rest of the world, that would be something that would stop me out. If the rest of the world no longer wanted to sell goods to the United States consumers and no longer needed to trade in dollars, that would tell me that maybe I need to get out. And when the rest of the world does this stuff while they're fighting the U.S. military, and they successfully do so, that would tell me to get out. But the other way to control risk is if you size the trade appropriately, the risk is already contained. So if I sent out a tweet back in March, this is on page 16, someone asked me, like, what does this milkshake overall portfolio look like, over the next 2 to 3 years? Now, and I said, I think if I had to start right now, I'd have about 20% in short-term U.S. treasuries or fixed income, 20% in precious metals, 20% in real estate, 30% in U.S. blue chips, and 10% in global macro or volatility. Now, that 10% global macro volatility, that is the area in where we have a fund where we're playing these very asymmetric opportunities if the dollar gets stronger. Now, let's pretend for an example. Now, that fund, I'll tell you, that fund was up dramatically in the first quarter and it was down a lot in Q2. It's still positive for the year. But let's pretend it wasn't positive for the year. Let's pretend it lost 100% of its money and the 10% allocated to global macro went to zero. Well, how is U.S. blue chips done? How's gold done? How's the short-term treasuries done? So my point is even if I get it 100% wrong, if you size the trade appropriately and you get the other stuff right, you're not going to be hurt. You're actually probably still going to make some money. The other thing is that if you look at page 17, I show that you can't be static. You have to be open and you have to understand that things might change. And I've used this chart to kind of explain to clients how I think things will progress over the next few years. Now, again, this isn't a guarantee. Things might change, which causes me to change this. But if somebody came to me with $10 million and asked me how I would allocate it now and how I think it would develop over the next 3 years, this is kind of how I think it would do and how I would change. Now, maybe I have to change some of it along the way. Maybe the timeline gets moved up. Maybe it takes longer. But the point is that if you size your trades appropriately, if you have a diversification and you have a plan, the risk is contained. The other thing is that, unless you want to bet big on one individual asset class, which is a good way to get rich or a good way to get poor. But if you want to have a diversified portfolio, the whole point of diversification is so that it doesn't all go up or all go down at the same time. So if you have a diversified portfolio, the first question you should ask is, where are you making money? And the second question you should ask is, where are you losing money? And if the answer to the second question is you're not losing money anywhere, well, then you're probably not diversified. So I think that's an important thing to remember as well. And then the last thing I would say regarding the dollar, as far as the thesis, is that my milkshake theory, which again, it's a theory, Erik. This isn't the milkshake fact. I don't know whether it's going to play out. But the theory is not based on technical analysis. It's not based on relative strength, and it's not based on, the COT data of a futures trader, how they're positioned. It's based on a long-term fundamental call that is based on the design of the monetary system and the fact that there is a flaw in the design of the monetary system. And that gives me a way to match my 2 to 3, 4-year time horizon with the time in which I think this theory will play out.
Brent, you got me curious because great minds think alike, I guess, and I think quite a bit about this lately, specifically the comment that you just made about changing the monetary system. It seems to me that the mood internationally has shifted from everybody knows the U.S. dollar is the global reserve currency forever to Everybody knows we're stuck with it because there's no viable alternative, but a lot of people are thinking pretty hard about how to come up with that viable alternative. Now, I have taken a view which is the most likely way this eventually resolves, and I don't think we're there yet, is a digital currency system emerges, unlike the cryptocurrencies like Bitcoin that were designed to defeat monetary policy. Instead, somebody designs one which is intended to enable a whole new style of monetary policy. It's a digital currency system designed to appeal to central bankers so that whoever develops it can sell it to central bankers and say, look, this is your replacement for the U.S. dollar that you've been waiting for. Now, that's my personal take. When you say, well, if the monetary system changes, what are you thinking? What kinds of things could come about that would provide a viable alternative to the U.S. dollar as the center of the entire global financial system?
Well, you know what? That's a fantastic question, Eric. My guess is that you and I could sit here and talk about this topic for 2 or 3 hours, maybe more than that, and not exhaust it. But in short, I will say that the design of the monetary system ensures that it's going to fail. It's just math, and it's not even difficult math. I don't have time to go through that all right now, but there is a design flaw in which the system will fail. So it's not a question of if, it's just a question of when. And it's my opinion, which I think is also yours, is that we're getting much closer to that end and transition to a monetary system than many people would like to believe. My guess is that it will be in some form, we will move to some form of a digital currency. I'm actually a big fan of Bitcoin, but I don't think Bitcoin is going to be adopted by a government. I think governments are going to issue their own coins. I don't think governments are going to willingly cede one of the biggest tools of policy that they have. It might be forced on them, but I don't think that they will willingly choose it. So I think before that happens, they will try their own digital coins. And the interesting thing is that this coincides with another battle within the monetary system, which I think is taking place, and that is central banks deciding monetary policy versus governments deciding monetary policy. And it gets into the whole central bank Keynesian system versus the MMT crowd, which says, you don't need to loan money into existence. It can just be spent into existence. And to your point about digital currencies, again, if you're taking the view from the government, not necessarily taking the view from an individual, but if you're taking the side and looking at it from a government's point of view, digital currencies would be a good way to get money directly to the people, to directly institute these MMT policies, to skip the banks where the money gets trapped and doesn't lead to the policy changes that they're hoping for. And so I think that's where we're headed. Now, I don't think we're there yet. I think we've still got a couple more years. And I actually think that this whole transition is going to take a little bit longer than a lot of other people. But there's no doubt in my mind that it's happening.
Boy, Brent, you're right. We could go on for hours and hours talking about this one, but I'm going to resist that temptation as much as I'd like to because we're halfway through the interview and haven't even talked about the stock market yet. So let's come back to page 23 in your slide deck. Talk about the S&P. Boy, looking at this chart, on the one hand, it looks like we're breaking out to the upside from the channel you've drawn here. On the other hand, last time that happened, didn't turn out so well. So what comes next?
Well, when we had the lows in March, you'll remember earlier in the year, I was hedged and expecting a sell-off. I was expecting a sell-off to the bottom of that red channel. Well, it actually went further than that. But we got fairly aggressive. For our clients who have exposure to equities, we got fairly aggressive, in March. And we had a nice bump. But, I thought we might bounce up back to the top of that red channel and then turn back down. But boy, it just continued rocketing higher. And now it's even broken out from the green channel. I am of the belief that we are going to have a retracement. I don't know if we will go all the way back down to the bottom of that red channel, but I think it's possible. And I'll tell you why. For people that are following along with the slides, on slide 19, I think that the mechanics of QE are dramatically misunderstood. And my point here is that the stock market has rallied strongly on the belief that inflation is now here forever. And I think that that is incorrect. I will make the argument that QE is actually deflationary as opposed to inflationary. Now, this is not to say that the government won't change what they're doing, the central bank won't change what they're doing, and do a new policy that will be massively inflationary. I'm just saying that as it's currently designed, it's not inflationary, and I'm happy to kind of walk through and tell you why that is.
Brent, let me just insert a question here about QE, because one of the things that you'll hear a lot, Ray Dalio says this quite a bit, is the way this all works when the central bank, the Fed, gets into quantitative easing. They're buying bonds from bankers. So the banks are receiving money for those bonds. And what the banks end up doing is taking that money, and of course, maybe the intention of it was to create more lending or something. The banks are not using it for that. The banks are taking the money they get for the treasury bonds that they're selling to the Fed, and they're using it to buy stocks, and that's pumping the stock market higher. Now, I think you have a different view. Why don't you agree with the very common description that I just went over?
Well, you're right. The description that you just explained is the completely accepted narrative right now. It is not technically correct, and I'll tell you why. On this page here, I've kind of showed the whole process by which cash gets moved around and the way Treasury funds itself. And we don't have time to go over the whole slide. But essentially, like you said, the theory is that the big banks buy treasuries, and then the Fed comes in blue at the bottom of this slide. I've showed that the Fed sends cash created out of thin air for the T-bonds to the big banks, and the banks send the bonds back to the Fed in exchange for the cash. Now, I've put this in here just as a way to explain it, but it's not technically correct. Well, it is correct. The banks do receive cash from the Fed, but they don't. It's not like a checking account. What happens is the big banks, they have an account at the Federal Reserve, just like you and I have an account at Bank of America or Wells Fargo or Bank of Montreal. The banks also have bank accounts. Their bank accounts sit at the Federal Reserve. So when the Fed buys a bond, they do not send cash to the bank that the bank can go out and spend. What they do is they deposit cash into the reserve account that sits at the Federal Reserve. Now, this is the key right here. This cash that is deposited into the reserve account at the Federal Reserve by law cannot be used. It cannot be, hold on. It cannot be withdrawn like a checking account. It can be used as collateral off of which they can create new loans, which is kind of, if you look in the chart from the, down the bottom right up to the top right, they can use the collateral that they have in their account at the Federal Reserve to create new loans. And if they were doing that, that would be inflationary. But they are not doing that. And they cannot take cash out of that Federal Reserve account and go buy stocks with it. This, again, would be against the Federal Reserve Act. So if you think that they are doing that, you also think that the banks are in violation of the Federal Reserve Act. Now, again, I'm not saying that they won't eventually get there. I'm not saying that the Fed and the banks won't get together and eventually completely and totally monetize the debt directly. I'm just explaining from a legal perspective, they are not doing it currently. And because the cash that the bank is getting for those bonds is not able to be used other than to create new loans, QE is actually deflationary because it is taking liquidity out of the system, not putting more liquidity into the system. These loans, I got a couple slides here which I can show you.
Hang on a second. Before you move on from this slide, I want to ask a clarifying question, because what you're saying is when the Fed buys treasury bonds for cash, that cash is credited to the bank's account with the Fed. It means that essentially that bank now has more bank reserves on deposit with the Federal Reserve, which is what they need to have in order to make loans. And you're saying, well, so it can't be used to buy stocks in the stock market. But hang on, Brent. Banks are in the business, at least to some extent, of making loans. And they're required by law to take money that they do have and put it on deposit with the Federal Reserve as bank reserves in order to collateralize those loans. So isn't it true that they've got money that they didn't have to put on deposit with the Fed because they got another source of funding the Fed? And so there's money that they've got that they can go buy stocks with because they don't have to take the money in order to collateralize their loans and create bank reserves, because their bank reserve requirement is being funded by the T-bonds that they're selling. So does it really work out to being, just a an alternative source of funding something that had to be funded anyway?
If the banks can source cash from a source other than the reserves they're getting from the Fed, they can do whatever they want with it. But they cannot take the funds they are receiving via QE and go buy stocks or go buy more treasury bonds. That cash has to sit at the Fed and it cannot be withdrawn. It's like a trust account. Pretend you're an 18-year-old kid, your dad's a millionaire, and he gives you a trust account. You know it's there, it's your money, you own it, but you cannot withdraw it. It's possible you can go convince somebody to give you a loan against it, and you can get some liquidity that way, but you cannot withdraw that cash.
Okay, Brent, what are the implications? You're saying there's a very widespread misunderstanding that people think that the Fed's buying bonds for cash and banks are using that cash to go buy stocks. And you're saying can't happen, that's not true. What are the consequences and implications of that misunderstanding in terms of how assets are either being mispriced or whatever it means to the market?
Well, the first implication is that the general market believes that the Fed is flooding the market with liquidity, and that changes their behavior. And so they go out and they buy stocks, and therefore you end up with a situation like we showed earlier with the stock market, being much higher. And so we've had this significant rally in risk assets based on a false belief. But the point I'd like to make is the fact, because it is in fact not inflationary, even though the belief is that it's inflationary, dollar liquidity, funding liquidity in the markets is not as high as many believe. And in fact, it's tightening. If you look at page 20, despite the popular narrative, banks are raising their lending standards. This idea that there's all this money in the system and all you have to do is go out and grab it is completely wrong. Banks are raising lending standards and liquidity is tightening. And that's not just with the banks. If you look at the shadow lending market and the peer-to-peer market, liquidity there is also drying up. And then, I show this slide where, missing their inflation targets has kind of become a way of life for the Fed and for central banks. Now, Powell is giving a speech tomorrow morning at Jackson Hole, and I think the whole topic is how they're now going to let inflation run hot, which I think is kind of funny because they want to let inflation run hot, but yet they can't even meet their target. But, that will no doubt have some kind of a market impact, whether he exceeds expectations or misses expectations. But regardless of what he says, the fact is that lending has tightened and liquidity is tightening, not the opposite. And so the implications, I believe, are that equities are going to have a pullback. The other implications, I believe, is that, treasuries, I think yields will continue to go down on the U.S. Treasury. If we get a hard pullback in the stock market, I would expect treasury yields to go higher. Now, listen, treasury yields at this point are just a short-term trade. We're approaching the lower bound. I think I'm not convinced we're going to go negative on treasuries, but my point is that I think we're going to have another move down in treasury yields and a rise up in prices. But then at that point, I think when the central banks have to come out again and do another program, that will be when yields potentially start to rise and when we actually get some inflationary pressures. And so I think gold is extremely important. It's sitting at a very important role right here now, too. It's basically back to its high from 2011. I continue to think that everybody should own gold. I've actually helped clients buy gold, physical gold, last 2 or 3 months. Now, that's not our speculative capital. That's our long-term insurance capital. I continue to believe that everybody should own it, but I also continue to believe that when we get in these periods where the dollar spikes, that gold will be seen as a source of funds. Again, I don't think people will sell gold because they want to. I think they may have to sell gold because they have to. And if gold does pull back, I would then expect gold to rally quicker than everything else, just like it did the last time. But I don't think it keeps gold from getting sold in the very short term. Another implication is that, I think that this big rebound in commodity prices is off. I don't think we're going to continue to see a continued rise in commodity prices. I put a chart here that basically shows a 25-year head and shoulders. It broke through the base and now it's come back up and it's retesting the base as resistance. I don't think it's going to break out from there. But Can I be wrong on this stuff, Erik? I can. I always say I can be wrong. And if I'm wrong, let's think about if I'm wrong. Go back to the milkshake theory portfolio. It says to own gold and it says to own equities and it says to own risk assets. I just happen to think you should own those things for reasons other than most people think. But if I'm wrong and the dollar goes lower and, gold goes higher and equities go higher, we're actually going to do pretty well. So that's kind of where I see things. I think the market in general has the narrative wrong, but it's going to be interesting to see how things play out, going into the election and the end of the year.
Let's come back to the gold chart on page 25. I don't want to gloss over this because we've had so much conversation in the past, Brent, about, you and I are both super bullish long-term on gold. We've also both been astonished at just how strong this strength has been. What was the 1350 to 1377 support line lasted like 5 years, and all of a sudden in 5 months it seems like we've just haven't doubled from there, but boy, it almost feels like it. Are you still thinking, last time we spoke was quite a while ago, you were still thinking at that point that maybe a retest of that 1377 was still in the cards because we haven't really seen a full technical correction yet. On the other hand, boy, just look at the money printing. It's hard to imagine coming all the way back down to 1350 from where we've been. What do you think? How big of a technical correction is still in the cards for gold if one comes about?
Is it possible to go to 1350? Yes, I would say it's possible. And it's not because it should happen. It's just based on the design of the monetary system. Now, can it happen? Yes. Will it happen? I think it's probably unlikely at this point. I think, going back to 15, 16, 1700 is easily possible. Going back to 1300, 1200, that's going to be a bit difficult. It could happen in some kind of a very, 1 or 2 day or a week spike lower event that gets recovered in 2 or 3 days. I think it's unlikely, but I can't rule it out. Again, I don't own gold for speculative purposes. I own gold as insurance. I think it's going to go much higher. I think every interview I've given for the last 10 years, I've said gold is going to $5,000. I haven't changed on that. I still think that it's more likely than not that we're going to have a pullback from here. Back down into the $1,600, $1,700 range seems very easy to me. Potentially higher, but I don't think it should necessarily keep you from owning gold unless you have a very, very short-term time horizon.
A lot of traders really put a huge amount of emphasis and trust in the commitment of traders reports. And what we're seeing here on page 26 really is the commercials, which tend to be the smart money in terms of getting the trade right. They're kind of at a high open interest level here. What does this portend? What does it tell us about what could be coming next?
Well, it's a couple things. Like typically what has happened over the last 10 years as the net short position of the commercials rose, it would eventually correct and it would eventually fall, and that would fall as the price of gold fell. Now, what's been interesting here is over the last, call it month, we've actually seen the net short position as a percent of open interest has actually started to fall, and gold has risen a little bit. Now, some people have interpreted that the banks are covering, they're getting short squeezed, they're closing their contracts at a loss. And, so I can't rule that out. That's possible. But because of this large short position by the commercials, I tend to believe that more likely than not, that is going to resolve itself with a lower gold price rather than a higher gold price. If I am wrong and the commercials have to cover their shorts, gold is not going to be at $1,900. It's going to be at $2,900.
Brent, let's go back to page 27, where you're showing on the long-term commodity chart, you see a 25-year head and shoulders pattern, and you're showing this correction below the red line here. Looks like, typical technical analysis formation is you break through a level on the downside, you kind of climb back up and kiss it, gives you one last chance to sell that level. Looks like that's what's happening right now. And if the pattern continues, which is not a certainty, then you'd expect new lower lows. Is that your outlook, new lower lows for commodities?
That's my very short-term outlook, yeah. I do think that we're going to get, over the next couple of years, I think we're going to come back, we're going to break out of that, and then we're going to be in a very long-term, very bullish market for commodities. I just don't think we're there yet. as long as the potential for this dollar spike remains, which until the monetary system is completely redesigned, the chance for a dollar spike always remains. That is what a credit crunch is. A credit crunch is the lack of dollar liquidity leading to a dollar spike. That's what a recession is. That's what deflation is. That's what a credit crunch is. So until that is redesigned and that is no longer possible, then that remains. And I think when we get a dollar spike, that will be negative for commodities. Now, it might not last long. They may come out and do some new program or new design or whatever, which changes things. But as of right now, I am of the belief that the dollar gets stronger and commodity prices remain under pressure.
I want to come back to Treasury yields for a minute because something you said there really interested me. So many people say this same sort of narrative, which is, look, the world's global reserve currency cannot possibly go to negative yields on its 10-year maturity government bonds. That just isn't possible. And, it sounds good. I like the ring of it, but I'm not really sure what the logic is to that because, frankly, the same people said the same thing about the German Bund 5 years ago, and look what happened there. But what is it that is so special about the fact that the dollar is the global reserve currency? Certainly, it does mean that central banks all around the world have to hold U.S. Treasury bonds. So is the logic of that somehow because central banks are holding them, the yield can't go negative? Why is it that so many people think the U.S. 10-year cannot go to a negative yield? And what's your view? Do you agree with that?
I don't necessarily. I think it certainly can. I'm not convinced that it will. A lot of my friends who are big bond bulls and, have been completely right, by the way, forever, are convinced it's going negative. I'm not convinced they're going negative because I'm not convinced they need to go negative. But I don't think that it is impossible. I think anybody who says anything is impossible is probably going to get proven wrong over the next 3, 4, 5 years. I think a lot of things that people don't think are possible are going to happen. But the one thing I would say is I don't think the Fed will take them negative, but the market might take them negative. I think for the most part, the Fed understands that taking rates negative are a trap from which you cannot emerge. And I think that is going to manifest itself in Europe over the next short while. And I don't think the Fed wants to get put in that same trap that Europe is in or that Japan is in. But the market could bid for treasuries in such a manner that it takes them negative. And that would not surprise me at all. I don't see the Fed setting them negative, but it would not surprise me at all to see the market take them there. Because everybody, again, it's not that people want to buy treasuries. It's not that people want to buy dollars. They have to in order to operate in the world today as it's currently designed. Now, can that design change? Of course it can change. But until it changes, you have to have dollars.
Final question. U.S. presidential election is obviously getting nearer. What are the implications of the sweep on either side? What happens if Biden takes this? What happens if Trump keeps it? Is it clear what the implications are for markets? And if so, what are they?
Well, I think the popular narrative, again, is that if Biden wins, that's bad for markets. And if Trump wins, that's better for markets. It's important. I don't want to diminish its importance, but I largely think, Erik, that the die has been cast. This is going to play out regardless of who's in office. The speed with which things play out may change a bit. I'm of the belief that Trump is going to win again. Now, I remember giving an interview a week before the election, last time, and I was pretty confident that Trump was going to win, and that turned out to be right. I don't have that same level of confidence this time. I still think he's going to win, but I don't think it's as sure as it was last time. With all that's going on with the protests and COVID, I think things are very, very, up in the air. I think that Trump is going to do better than the left and right coast and the, kind of the traditional media thinks he's going to do, but I don't think it's going to be easy. And I think regardless of who wins, Erik, I think the November and December are just going to be absolute crazy because regardless of who wins, the other side will not accept it. Guaranteed. There is no way the Democrats will accept it if the election says was run by Trump, and there's no way the Republicans will accept it if it says Biden won. It's going to be decided by a lawsuit. I'm convinced of that.
Brent, before I let you go, please tell our listeners how they can follow your work and what you do at Santiago Capital.
Yeah, so Santiago Capital, it's a wealth management firm. I don't have model portfolios where everybody comes in and does the exact same thing. I've only got a couple, less than 24 clients. I customize everything to the individual. And, they're all kind of fairly significant net worth clients. In addition to that, we run a fund, which again is playing the dollar asymmetry trades specifically. My contact information can be found at santiagocapital.com. You can feel free to follow me on Twitter, Santiago Capital. Also, Santiago AU Fund is the handle. Feel free to email me. Feel free to send me a direct message. I get a lot of them, and I've kind of failed in responding to all of them lately because there's so many of them, but I do enjoy interacting with people. I'm happy to answer if I have the time to do it, so feel free to reach out.
Thanks, Brent. We look forward to getting you back on the show in a few months for another update. Patrick Ceresna and I will be back right after this message from our sponsor. Farmland investing has been a popular macro trend among billionaires and big institutions for the last decade. But the high cost of buying an entire farm put this asset class out of reach to all but big institutions and the ultra-rich. FarmTogether.com allows any accredited investor to invest in fractional ownership of several different categories of farmland. I recently did a full-length interview with FarmTogether.com founder and CEO Artem Milinchuk. We discussed the macro argument for farmland investing, performance and correlation comparisons to conventional asset classes, and the different types of farmland and their investment characteristics. If you're an accredited investor, I recommend that you listen to that interview and learn why farmland investing might be a fit for your portfolio. You can find the download link in your Research Roundup email, or just type the word farmland into the search box on our homepage at MacroVoices.com. Check out FarmTogether.com today. You'll be glad you did.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was so great to have Brent back onto the show. His views on the dollar, I agree a lot with, in principle, his core views on the dollar. And when he was referencing the technicals, the one thing for me, while he does that trend line that suggests that there's a key support here, I still think there's room for the dollar to even weaken down to retest those 2018 lows and still not violate the bigger uptrend that's still in play. And so while he's certainly looking for this to be a key support, I still think that if the dollar even weakened down to the 90 handle and then bounced back, that it still would be uninterrupted in its trend. But nonetheless, what did you take away from the interview?
Well, I really agree a lot with Brent, and particularly what I respect about Brent is, he's one of the grown-ups in this business. He knows that nobody's right all of the time. Brent and I have both had a dollar, I don't want to say dollar bullish view. As Jeff Snyder has said, it's a view that the dollar is likely to appreciate. It doesn't mean the dollar is healthy and strong and wonderful. It means that for technical reasons, it's broken in a way which is likely to make it appreciate relative to other currencies. It's at a point where we're getting pretty darn close here to a technical level where you just have to say, look, it looks like we're wrong about this. I really am looking forward at some point to getting Luke Groman back onto the program because I'd like to get his take on this. He's the guy who's been calling for dollar down and the end of the dollar's hegemony over the global financial system for years now. Is Luke finally being proven right? I agree with Brent that there's a long list of things that could happen, such as the emergence of a digital currency that provides a viable alternative to the dollar as global reserve currency. That would just, put the death knell in the dollar overnight, and you could see a big crash situation if there was really a viable alternative that central banks started to really jump on as a new trend. I just don't see that happening yet. So I'm still leaning with Brent that there's plenty of room for this to turn around. The thing is, we've been wrong for the last month. This can't go on a whole lot longer before it's time to just say, okay, some reason it's not working the way we thought. In any event, Patrick, I want to get on to your chart book. Listeners, you'll find the download link in your Research Roundup email. It says Big Picture Trading Chart Book. What are we looking at today, starting with page 2, S&P futures? Ta-da! There's that acceleration I talked about in last week's market wrap to the upside.
That's right. And so we've seen the S&P consolidate into the option expiration, the gamma pin that was going in. We were looking for volatility. My bias was that it was going to be the downside, but clearly the volatility came back and it was with a big breakout to the upside. And what's interesting about that breakout, we've put on ourselves just the calendared straddles that we've done in the past. And while it really does help that this market is starting to move quickly, it doesn't really matter which direction. And the fact that this market is moving this way, I kind of asked the question, well, what is the drivers behind it? And this is where I thought was really interesting on chart 3. And this was a Goldman Sachs chart that they put out that was actually showing a really amazing phenomenon that's been happening. And that is the fact that in the options market, we are seeing that now 75% of the total open interest volume now lies in the weekly options that have 2 weeks or less till expiration. And so what we've seen is this speculative fever really grasp investors that are playing this rocket momentum that's happening in the markets by playing these front month options. But there's an interesting byproduct of that is the fact that the dealers who are often on the sell side of these call options, in fact, have all of this gamma risk. And in fact, as the market rallies, it's actually forcing them to be the marginal buyers of the stocks to stay delta neutral. And so we've found this real kind of fuel or accelerant that is actually accelerating the markets. And what's amazing as well, if you look on the right-hand side, what you can observe is the fact that the volume of call option buying is skyrocketing while the growth in volumes in put option buying is actually substantially curtailing from the highs. And you would think that with the market up along their highs, it would actually increase the desire to hedge some of the risk. And instead, everyone is just piling more and more into these call options on the upside. And this continues to drive and be that momentum, like throwing gasoline on a fire.
Patrick, moving on to page 4, holy cow, look at the size of that spike in the premium for S&P puts. Obviously, it's easy to say that's because of the pandemic crisis emerging, but wow, look at the size of that. What's going on, and what is the significance of coming back down to that red trend line?
So, Erik, when looking at this chart, what is amazing is that obviously when the market was crashing, the cost of buying out-of-the-money puts as insurance skyrocketed, and that's what you're observing. But prior to the corona crash, generally what we saw was that the cost of put options was relatively cheap, and especially when everyone's short gamma, and generally it was a period where buying insurance was relatively cheap. Now, in the post-corona period, we've seen volatility start to normalize. We see the VIX heading back down toward the 20 handle at this stage. But generally, as we showed on the previous chart, there isn't a structural demand for puts. No one seems to be worried about the downside risks of the market. And generally, the cost of these out-of-the-money puts are actually now coming to levels that are historically reasonably priced. I mean, we're to like the 85th percentile in terms of where we've been trading. But more importantly, since the coronavirus February, the median premium was 1.9% over the past 6 months. And so with us now being very close to 1%, it hasn't been much cheaper than in the last 6 months to buy put protection with the stock market up at along its all-time highs. So it's interesting that we're up here. And if you wanted to keep staying along the stock market and pressing up, it doesn't cost as much. It's never been cheaper in the last 6 months to buy put protection on your portfolio.
So the strategy of a long protected by a protective put, what some people call a synthetic call strategy, is cheap again, which it hasn't been since the crisis began.
That's right. And so it's just a thought that, those people that want to continue to participate on the upside of the market, starting to put in some hedges, it might seem like a reasonable proposition after we're going almost 5-6 months of pretty much straight up on the market, right? And so another interesting thing I wanted to look at on is page 5 and 6. And I just really wanted to put in context the magnitude of the rally that we saw in the NASDAQ over the last 5 months. And so what I wanted to start with on page 5 is just looking at the fact that when you go back to the 1999-2000 blow-off of the NASDAQ, when it broke out, it rose in 100% or doubled in its value in 160 days. And what's interesting is we are now approaching the 160-day mark off of the coronavirus low in March. And so on page 6, what we can see is that we've now seen a 70% rise in those 160 days. And so it's interesting to put context in terms of just the magnitude of the rally. Now, admittedly, there's a reflexivity to the fact that the NASDAQ crashed in the prior month before this rally is being measured. So I'm measuring off of an incredibly oversold low, but it is just showing you also the magnitude of this rise. And I mean, it's a second only to one of the greatest bubbles we've seen. And it's really interesting to see how long the bulls can keep this momentum running before we see that mean reversion that inevitably happens on every one of these types of rises.
Well, it certainly is fascinating, Patrick, to see just how dramatically the recovery has been. And I think it makes perfect sense. The NASDAQ, primarily tech stocks, which are, less affected. There's a lot more people buying stuff on Amazon and watching their Netflix accounts because of the crisis. Straight up and new all-time highs. And it's just amazing. Not only is it interesting to me that 70% has happened in 160 days, but look at the difference between the March bottom. You got back up to the previous all-time high, and then you went more than that's, the distance from the March bottom to the all-time high. You went more than that much up again in order to get to the current high. So it's a really profound move. Speaking of profound moves, let's move on to page 7. Lumber futures. Oh, wait a minute. Is this Tesla or lumber? Yeah, it's lumber futures. That's it.
Everyone's talking about this parabolic rise or this big, huge rise in the NASDAQ and technology stocks, but there is one market that has actually been outperforming the NASDAQ, and that is lumber futures, which are limit up today, and they, off of their March lows, are up 250%. And so this has been just a stunning trade for anyone who's gone long lumber. And what's amazing to me about what's happened here is that intuitively, on one side, I would have thought that with a huge rise in unemployment, that generally that would have actually decreased the demand for new homes and real estate. But in fact, what we've seen is the opposite. We've had Josh Steiner and Kevin Muir talking about this idea that inevitably the millennials are going to enter the housing market and start to buy homes, and that there was going to be a boom driven by the millennials making that move. And what we're finding, at least the speculation is that with the coronavirus basically shutting down cities, it actually has acted like the trigger or the fuse to actually begin this transition, and the demand for homes has actually been skyrocketing. At the same time, we're seeing that many of these mills have just not been running at full capacity because of the coronavirus, and this has created like a perfect shortage in lumber. And it's going to be really interesting to see how this plays out. I mean, this thing is just going absolutely mental to the upside.
Patrick, I think the trend that underlies all of this has a long, long ways left to go. Now, I don't know if it manifests itself in even higher lumber prices or not. You'd have to do some analysis on exactly where the bottlenecks are in that market. But I don't see it quite the way you and Kevin do, where you're talking about accelerating a trend that might have already been in play with, let's say, a millennial generational, move out to the suburbs, and that creates some more demand for housing. I think that the coronavirus crisis potentially is going to change the world forever. And the reason is it's the catalyst that really brought about a change that was already enabled by technology. We've had the ability Let's say, take New York City, the most expensive real estate, or maybe second most expensive real estate next to Hong Kong in the world. Why would you pay, $2,000 a square foot or whatever it is to buy an apartment in New York City where a little studio apartment costs upwards of $1 million? Well, the reason is if you want to work in the finance industry, which is probably the best paying jobs anywhere, it's where you physically had to be. And second of all, in terms of, restaurants and being able to enjoy your wealth, New York City is the place, best restaurants on earth, it's it. You can go to just a few places around the world, like Aspen, Colorado, where they have bordering on New York City quality of restaurants and quality of amenities for life. But there aren't many places like that. Usually the trade-off is you move out of the city and you end up with crappy restaurants and not the kind of selection that city dwellers get used to. I think that what we're seeing is the beginning of a trend whose real enabler is technology. It's the fact that we can work from anywhere over the internet that is going to make it possible for people to move out of big financial centers like New York and London and so forth and live in the countryside. And if I was a real estate guy, you got to invest in what you know and understand, and real estate is not my thing. But if I was a real estate guy, I wouldn't be looking at building the next hotel or the next little, bunch of tract houses. I would be saying, look at a map, find me closest to New York City that I can get, where I can buy a lake and 10,000 acres minimum, and I can develop a new high-end Aspen, Colorado-like place that is out in the sticks where everybody gets a 2-acre lot and it's on the lake and they've got their little dock with their boat and the whole living in the country bit, but it's got restaurants that are like New York City and it's got solid public transit and we're going to build that whole village. I would be looking at that kind of project because I think the move out of New York and move out of London and move out of Los Angeles trend is going to be huge, and it's going to depress property values in inner city environments, which used to be the most valuable real estate. And I think it's going to put demand, especially on high-end housing, in resort areas. And you're already seeing it with places like Whistler, Canada, and Aspen, the best ski resorts that are also summer vacation destinations are going to turn into full year-round destinations. And you're already seeing that. And I think the building in those areas is going to go through the roof. But let's move on to page 8, Patrick, and talk about iron ore. Why did you pick this chart to add to the book this week?
So, Erik, I want to actually talk a little bit about inflation. And one of the biggest inputs in inflation are commodity prices. And the biggest one, of course, is crude oil. But we already talk about that on every single show. What I really wanted to do was touch on some of the other ones that we rarely touch on. And so we talked there about lumber, but now I want to talk iron ore. And iron ore continues to gravitate toward 5-year highs. And it will be really interesting to see whether big breakouts in these types of basic materials really start to emerge and really reconfirm this idea that some sort of material rise in commodities is underway, which will inevitably translate to some transitory inflation that will start to reflect on the charts. And so what's interesting is that when we go to page 9, I have the 10-year break-evens. And what we can see is not only are we seeing the high of the year printing right now, but we're actually approaching the 2019 highs, up around 180. And so it'll be really interesting to see whether or not these inflation expectations continue to edge higher. And when we go to page 10, we can really see what I have is the 210 steepener. And not only were we negative and inverted on the curve back in 2019, but we now are finding ourselves putting in what was clearly a bottom along there, and we're making higher highs and rolling up. The particular interesting thing about this yield curve steepener and the idea is that it really would have to be a bear steepening. The Fed is not going to take their foot off of the front of the curve, pinning it down toward zero. And so really what this is going to be all about is whether or not inflation expectations rise and it starts to be baked into that 10-year yield. And it'll be really interesting to see whether we're in the midst of a new breakout in the steepener.
Patrick, you make excellent points. I think it is important for us to point out, in the case of iron ore at least, iron ore comes from Australia and Brazil, two countries very, very badly hit, particularly Brazil, by the COVID-19 crisis. So one of the things that remains to be seen is, first of all, how long does the crisis last? Because nobody really knows. When we do get some degree of recovery from the COVID-19 situation, do those iron ore prices come back down because they were driven so much higher by mining difficulties of production because of the crisis, or were they set to have this move anyway because of inflation, and the COVID crisis just provided the catalyst to turn their direction around? That's going to be really interesting to see, but I think the inflation break-evens suggest maybe it's more likely to be the latter. Meanwhile, Patrick, the latter slide in the deck, slide number 11, tells our listeners how they can get a free trial to your service, Big Picture Trading. Folks, you can get Patrick's commentary just about every day, 4 days a week, on bigpicturetrading.com. Be sure to check it out and get your free trial. This episode of MacroVoices was made possible by farmtogether.com, making farmland investing a $1 trillion asset class available to all accredited investors. And by TopTradersUnplugged.com. Remember to get the ultimate guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. For information on sponsoring Macro Voices, please visit macrovoices.com/sponsor info. Listeners, be sure to register a free account at macrovoices.com. The benefit to you is you'll receive our Research Roundup email, which provides you with all of the best free content that we could find on the internet each week, including downloads associated with our guest appearances, as well as, of course, our post-game chart books. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to Brent's charts and the chart book we just discussed in the postgame. There's also a link to an article asking, is the euro living on borrowed time? And a link to a talking data interview with Jim Bianco on what's next for inflation. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.